Let's move on and talk about the banking space now. N. Kamakodi, the MD and CEO at City Union Bank, joins us to discuss an outlook on how their business is shaping up. Mr. Kamakodi, good morning. You know, the deposit momentum has been on the weaker side for a while. Can you give us an outlook on how the rest of the year may shape up?
Basically, in this year also, we expect the deposit growth may be slightly lower than the credit growth. And one thing what we have to keep in mind is that if you take a 10-year horizon roughly, one-third you will be having a deposit growth outpacing the credit growth, and one-third of the period when the deposit growth is lower than credit growth, and maybe for remaining one-third you will be having growth almost in tandem with the credit growth. So these sort of, like say, fluctuations are often given in the interest rate cycle, depending upon the liquidity position and like say how the central bank wants to have surplus liquidity and all. The rates get adjusted accordingly, and overall, I have not, at least so far, seen like say many instances when the growth of credit is impacted by not having sufficient funding and all. So this is something which is happening in every cycle. We need not like take too much out of it. It's something which we have been seeing in every cycle.
So what does this mean in terms of loan growth? How much has the loan growth been so far for City Union Bank, and what is the projection for the full year?
We had closed first quarter with about 12% growth. At the beginning of the year, we said for the whole year, we will be having 12 to 15% growth along with the fourth quarter results of the last year. But along with the first quarter results, we said probably we will be closing the year with about 15 to 18%, where the bulk of the growth will be backloaded towards the fourth quarter, mainly because we expect the investment cycle to start as the capacity utilization is increasing, particularly in the SME front.
15 to 18% loan growth for full year FY23. What percentage of the lending book is linked to external benchmarks? Rates are rising in the system, right? Does it, what is the impact?
Basically, in every, as you see, almost maximum as much as more than 90% of the loan book is floating, either with the external benchmark or with the your what you call the other benchmark rate. So the already about 50% of the incremental rate had been passed on. So the you will be seeing during the interest rate increasing scenario, already we are also seeing reports that surplus liquidity is totally absorbed and we are into the deficit thing. So it's an indication that rates will get firmed up. So there will be increase in the yield, and the deposits, particularly term deposits, they take longer time to reprice. So we will be getting into a period where the margins will be showing like a upward bias.
Your slippages had gone up quarter on quarter at about 270 crores in the quarter gone by. That was over a 22% growth. Any indication on asset quality? I mean, will there be a further increase in slippages, or do you think asset quality will be under control?
Basically, you are seeing quite a good improvement in the asset quality. Like say pre-COVID period, we typically used to have about like say 2 to 2.5% slippage for the 3 years prior to the COVID. But during the COVID years of 2021-22, we saw the slippage ratio coming to about 3 to 3.5%. But for the last 2-3 quarters, things have stabilized. More than slippage, there used to be issues with the recovery because courts and all were not functioning during the COVID period. That has improved, particularly if you take a credit for the write back of return of assets. The gap between the slippage and the recoveries have narrowed down, and so which means effectively you may not be requiring any incremental provision, as the reversal of provision itself will take care of the incremental provisions for the incremental NPA and all. But nevertheless, we will be continuing with the provisioning to get the net NPA level lower. In fact, we are seeing a good improvement in the NPA numbers, both in terms of the slippage and also in terms of the final numbers.
Mr. Kamakodi, good morning. You know, the big chatter in the market has been about the consolidation or likely consolidation in banks, and especially the ones which don't have any identifiable promoter. I mean, like yours, promoter holding is zero, right? It's owned by institutions. Do you think that's going to be a likely scenario going forward?
I am probably almost 20 years in the industry, and I am facing the same question for the past 20 years, and I am giving the same reply.
I'm asking the same question for last 20 years. I'm also in this profession for 20 years.
Basically, for any institution, be it bank or any business per se, as long as you are adding value to your stakeholders, be it customers, be it shareholders, be it employees, nobody can question your identity. And when we have seen in the past, you had not seen many consolidation where it was for the voluntary consolidation for the, like say, purpose of creating value and all. Even in hindsight, looks like those banks which merged themselves when we are doing well, probably they would have created more value had they maintained their identity. And all mergers had happened when there were serious issues with their performance and probably other complaints and other regulatory issues and all. So we, as our return ratios, be it ROA or ROE or growth or whatever way, is like say almost in top 10%. We don't see that as a strategy. We will be striving to move forward with like say growth and like and our return on equity, return on assets and all are closer to the like say top 5 in the industry and all. We hope we'll be maintaining our identity as we have been being the oldest bank with over almost 120 years of existence, making profits and declaring dividends for all the close to 120 years. We don't feel any reason for that at this moment.
All right, Mr. Kamakodi, we'll leave it there today. Thanks a lot for joining us.